Thank you for the kind introduction to Jean-Michel. As you heard, I work for Platts, and I have been with the company for about 27 years. So I have heard a lot of stories, seen a lot of trends and waves and explanations for how things happen. And hopefully, or one would think, after all these many years, things start to make sense. From where I sit, we're in the middle of, I would say, a 30-year cycle, roughly. We had a similar event as we are seeing right now in the mid-'80s. It's quite dramatic and traumatic. But at the core of it all, I think it's good to start by thinking the following. There is nothing like high prices to cure high prices. Prices were really historically high for quite a long time, for a number of years in the 110, 120 period, and you'll see some graphs about that. And prices were even above that for some time. Those high prices spur innovation, spur changes in demand, and just generate their own cycle where high prices cure high prices. And there's some cyclicality about what happens in markets. So here you have a graph that shows supply from non-OPEC sources, the red line, trending up, and supply from OPEC sources trending down. And by definition, if prices are high, you will have investment, innovation, greater production, typically in the areas outside of OPEC. OPEC tends to be conservative and also mired with what would only kindly be said as political tensions, right? So as production in non-OPEC starts to fall relative to the rest, there will be some concern in some quarters, primarily among the big countries such as Saudi Arabia, to try to regain that market share. And if you think through, the oil market is roughly 90 million plus barrels per day, and 3 countries account for really over 30 million, over a third of that. And at times, those countries can be friendly, at times they can be unfriendly, and at times they have conflicts of goals, right? Those 3 countries are Saudi Arabia, the US, and Russia. And roughly, however you count it, they're in the 10 million plus or minus production per day. So it's a market of what I would call big guys. And what one does will affect the other. And right now what we have, strange as it may seem, is a tension which is very obvious and in a way historical between Russia and the US, so we can forget about that. Not that we shouldn't, but for purposes of this discussion, the interesting tension is what is happening between Saudi Arabia and the US. Typically, these 2 nations have been very friendly, supported each other politically and in terms of oil matters. I have noticed sometimes it seems that Saudi Arabia is selling oil to the US that economically could find a better market elsewhere. Yet, at the present time, there is a little bit of political tension there as the US is seeking other friendship venues, even with countries like Iran. But the US is increasing production by pure market force, with Saudi Arabia becoming increasingly concerned about what it means to its economy and markets. So late last year, OPEC, meaning Saudi Arabia, decided it would not accommodate the rise in production in the US and would not cut back and just continue producing and supply the market as it could. And that essentially meant that that imbalance in supply that was occurring because of the rise in US production just hit the market on the nose or on the chin or in the eye, whatever image you want to use. And it caused a massive price correction, which is seen here in the graph on your right-hand side. One of the things we have learned in oil markets, and I think you have seen that in finance many times, is it takes some time for things to build. But when the correction happens, it's severe, sharp, fast. And that's what we saw in oil markets right now, dropping roughly from the 110 mark to as low as 45, like that. I think Jean-Michel was indicating that if anybody had said last year that there would be a correction and a positive impact in the economy, everybody would have said this is unexpected and you should go to a loony bin or something to that effect. In the oil market, I would say there was debate about when the correction would occur, and that was covered extensively in some quarters because a lot of people in the oil market still believe, despite sometimes evidence to the contrary, that markets should work based on fundamentals. And we saw the production in the US rising, and you'll see some graphs like a rocket. And if production rises at some point, there's an imbalance, a buildup on inventories, and price should correct. But the situation in North Africa and other areas compensated for that extra production. So to us in the marketplace, it was really a question of when rather than if oil prices would correct. What nobody knows is to what extent is that correction and then the subsequent recovery. There's a whole bunch of people in financial markets primarily that say that the correction means that prices will fall by 50%, and then after the fall, they'll rise by 50% of the new level, meaning that if prices fall to 50, they should rise to 75. And there's something like that going on at the moment. This graph shows the structural curve in markets, meaning the price difference between prompt oil and forward oil. In a physical market, such as crude oil, you cannot store oil for free. If the market is in surplus, you can store it, but it'll cost you X to store it depending where you are. And that creates a market structure. And what we see here is since the middle of July last year, the red line or the red bars show the contango or backwardation for Brent. The blue line is TI in the US. And if the market flips from prompt oil being more expensive than future oil to oil being cheaper than future oil, it means there is an imbalance in the market where people are selling oil that is prompt very cheaply because there is no market for it, and then it goes into storage. And that situation was clearly evidenced by middle of 2014. So many of us were very bearish as the signals started to come out that a surplus was developing. And you see that month on month, how that surplus is evidenced by that red negative bars. And then it showed up as well in the TI market, and it started to accumulate very, very fast. And as the contango becomes very big, then at some point it punches the the flat price, and then we had the correction we saw really in December last year, and that has continued very, very severely through this year. So one of the takeaways I want to share with you, because I know that you're in insurance and financial matters, is look at the physical markets and really the discount of premium of prompt oil relative to future oil. That'll give you a little bit of a view on what's going on. Then here are some of the numbers that impact some of the countries that I think you serve and some of the markets you serve. The correction has been very extensive. And as you can see, it's almost like those magic numbers about 50% retracement or whatever it's called in financial markets is almost acting correctly, right? Last year, the average was close to 100, and so far the average this year is close to 50. And right now, we're in the middle of a recovery. That has tremendous impact into countries that are dependent on oil. And there is an impact into countries that are tied into the US dollar and countries that are not, and I'll go a little bit into that. But one of the takeaways I wanted to give you is that the situation you're seeing is not just in oil markets, it's across a whole array of commodities. And one of the primary ones where it's evidenced very clearly is in the price of iron ore. Iron ore is another industrial good or feedstock that is consumed extensively in developed economies, but very much in emerging economies and in China to build bridges, housing, cars, whatever they have. And an equal surplus was developing in that market, with the market going into contango. And that market also fell by about 60%, with, again, a minor recovery right now as I guess the technicals kick in. So make no mistake, this is a global correction across all commodity classes. I really cannot think of a commodity class that was spared. And part of the issue here really is, as indicated in the previous presentation, China is maturing, is resetting as an economy. The number of inputs it needs to create a dollar of GDP or a yuan of GDP has changed in recent years, and we expect that percentage of primary resources going in for the Chinese GDP will continue to decline. They're maturing. Oops. The impact, as I mentioned before, is very severe on countries that are pegged or unpegged with the US dollar. And you saw some massive corrections in the ruble. And you haven't seen a correction by definition in countries like the Middle East that are pegged to the US dollar. This itself has a lot of impacts that one, I think, needs to devote a lot of time to think about what it means. But I was in Russia a couple of weeks ago and talking to the taxation authorities there. They told me that their receipts year on year were actually increasing because everything is in rubles. And therefore, the cost on a dollar basis for an exporter of oil have declined, and yes, the exports on a dollar basis have also declined, but maybe in some cases have increased on a ruble basis. So Russia, to me, seems to be weathering the situation a little bit better from a country budget point of view basis. From people in the street, of course, inflation is fed into the system, but that in itself spurs other types of production internally, right? Because it's better to increase dairy production or food production or whatever internally. The opposite is the situation in the Middle East, where all the countries are pegged to the US dollar. They are seeing a real net decrease in their receipts, in their home currencies, but the people in the street are not seeing an increase in the day-to-day goods because the currency is pegged to the dollar. That is going to have an impact of its own, and one can just wonder if this correction is long, what will cost to those pegs. So by definition, what is good for one is bad for the other. Whether you peg or unpeg, there are winners and losers. But in general, I would say that the loss in revenue to the oil industry is between $5 and $6 billion a day, is what the producers are not receiving globally. If you add in the revenue loss in agriculturals, in metals, in all those feedstocks, you are between 7 and 8. And so globally, that number is not too different, I think, from the UK GDP. That's the reset that has happened financially. And therefore, there will be a trigger, and that was explained in the previous presentation. There will be a feed into the economies. There are some where the impact of a low commodity price is more directly associated at the consumer level, and that would be the US. Hence, I think most of the indices barring the day-to-day fluctuations in the stock markets are at record highs and still with a tendency to the upside from where I see it without being a financial analyst. The kick into other economies like the Eurozone is a little bit less strong because the taxation here is very high, so the transfer of a low commodity price is not as high. And in addition, the euro has lost ground relative to the dollar level. But as a whole, for the world, if you're not a net producer, you should be doing fairly well. Your economic situation improves. Here, there are some numbers that you can see where the budget numbers were for some of those countries that are net producers. And of course, they need to reset themselves because the oil price is about $65, between 60 and 65, and that is going to cause a lot of rethinking about what they can do, how they're allocating budget, and like in the Middle East, a lot of money is currently being consumed by the military expansion that is happening there. And I think something is going to happen there in terms of the budgets or the peg. The impact to the economies to the companies is tremendous in terms of capex cuts, in terms of personnel loss. Schlumberger, a company that provides services to oil companies insofar as drilling and technology and things like that, had a first round of cuts of 9,000 people. And very recently, I think last week, another 11,000. I was at their offices in the US in January. And really, you could play soccer in the middle of their offices. It was like a neutron bomb had been let go in the area. But that's part of the efficiency of the system. If employees are not needed, then employees are not needed and the company can carry on. And they were explaining to us how efficient they were becoming. Essentially, in their eyes of an oil producer, the disaster of the oil price is causing them to really reset. There are a lot of meetings right now and some conferences in the US, and some of the executives are saying that they had a hard time putting through the efficiencies they need in their companies, which was obvious to them, but the price was 100, and then you get a lot of resistance from your troops say, well, we don't really need to do that, do we? But now that the price is 60, they can pass through those efficiencies. So you're going to see a lot of changes in the oil industry. I think a better NOI, insofar as the amount of money that they're spending is going to take a little bit of time. But some companies are very good, and I want to bring you to the statement at the bottom, which is from one of the service companies. Essentially, what he's saying is, for every dollar we're going to lose in revenue, we're going to cut $1 in costs to ensure that our profit remains the same to our shareholder. And that's a very mature way of addressing issues. It's a little harsh, but that's what business is. The resets happening everywhere are already impacting the consumer, right? Primarily in the US. And you can see here a little bit about the car sales. So there's going to be a big impact into the consumer, because the second part of how I started this speech, with high prices cure high prices, low prices cure low prices. And if energy is considered to be cheap, then people buy a big Silverado vehicle, big consumer of gasoline, or a F-Series truck, right? And in the US, the bigger sales, the better sales now in cars are for gasolers. Not quite gasolers, because technology has changed, but cars that consume more gasoline. The miles driven are growing, and people are expecting a growth between 2 and maybe 4.5% in gasoline in the US. And if you're in the top end, that's equivalent to 2 new world-class refineries. And then you see the resurgence, right? How the market is coming back a little bit again. Here is the graph of the gasoline, and you see how the markets work, right? They never go unidirectional. There is always a change at some point. To some degree, that change in gasoline patterns in particular, and to some degree in diesel, is even giving a new lease of life to many of the refineries that we were expecting to be shut down in Europe. So the low crude oil price results in low diesel and gasoline prices, spurs demand, and then refineries that were going to be shut down are not. I was in Geneva last week, and I had a meeting with Total, and they were very pleased that they didn't need to do anything harsh to their systems, right? Because demand was coming up, and margins were better than they were expecting too. So I think there are going to be some positive surprises in the performance of some of these corporates, because the bad scenario and perhaps the provisions that we're taking are at least not happening in this first half of the year. And here is where we are right now in terms of crude oil production in the US. As you can see from that graph, it's like a rocket taking off. The vigor, the innovation in the US is really fabulous. And I was very much looking forward to the production exceeding the ever historical high, but I guess prices may have corrected a little bit too early. And we're nearly at the same high level we achieved in the 60s. And there's a lesson there. If you meddle with the market will not work, right? And in the 70s, when prices went up, in fact, you should have had an increase in production when the 70s, when oil prices quadrupled then. But then you had price controls in the US. The US was very much in a very old economy point of view, very socialist insofar as energy, and the prices were not transferred to the field, and therefore destruction of that capacity, productive capacity, occur in the US. This time is different. The impact is directly, and the market is sending signals whether they should produce more or less. But one of the things I want to bring your attention to is innovation. I was in the US talking to some of the shale drillers, and they told me that 2 years ago, they needed roughly 44 days to drill a shale oil well. And that within a year, their productivity had improved to 22 days per well on average. And coming here this morning, I was reading some articles that in some cases now it's 5 days. Some wells, 5,000 feet, can be drilled in 5 days. In these circles of fundamental people in the oil market, there are some folks that think that the US will not be the marginal producer because it takes time to bring the trucks and drill and put the pipeline and everything. And there are some other folks that are in the field and myself that thinks that it's just a question of time for the efficiencies to kick in and for the ability in the US to really react to price. So right now, we are in the US in the mid-50s, really. And that was the level where, in the way down, people started to get fired at the fields. So in theory, if we cut across that mid-50s number, people are going to start getting higher again to start producing and drilling more wells. And now everything is computerized. One of the things I was hearing is that the folks in the field that are drilling those shale wells essentially operate like the tire changes in the F1 series for cars, right, where they all come in and change all the tires very efficiently, almost like little computers, right? So the companies monitor the efficiency of the teams drilling. And if there is a swoon in prices as there was, or there is, then you have to remove the inefficient teams, and you leave the teams that can drill a well very fast, can put all the pipes together and do it super well. So the system is really improving in an incredible manner, where the equipment is smaller, the platforms are smaller, and everything is controlled, very computerized from Home Central. So I think you're going to see more and more energy coming out of the US. To highlight a little bit, there's an area in Pennsylvania called Marcellus. And in one of the trips there, I was told that and this is discoverable in effect, that the BTU output of the shale gas area in Marcellus in Pennsylvania is equal to the BTU production by the United Arab Emirates, about 3 million barrels a day equivalent. And this is just merely scratching the surface. In the US, that's not a mature gas area, starting right now, it's about 5 years old really, and already produces the same as the UAE. What you will see in the US is, and has been happening already, is a huge amount of investment into petrochemicals, into usage of gas industrially, and I think there's about 30 big plants being built there. And one of the terms they're using in Platts is that the US will become the plastic basket for the world. It'll just produce commodity plastics and just supply the world. That is going to put a little bit of a crimp on Japan, on Korea, on other areas that have high costs, and that's always an issue in Europe, because Europe is high cost in terms of feedstocks, high cost in terms of personnel, high cost in terms of resetting. And so it's not very helpful from another point of view. Time, I think, is running a little short, so one of the last things I wanted to share with you is what is happening in terms of inventories. Inventories, as I said, get built or get consumed depending on the market structure. And because the market structure has been in contango, oil is being stored. And look how that graph looks. Inventories are at a record high ever. Nearly 500 million barrels being put away in the US. The structure pays for that because the discount from 1 month to the next is over $1, and it costs you less than $1 to store it, so you just put it away and use the futures markets to essentially benefit from the difference between what the market pays and what storage costs you. So as a closing point, we went below 50 towards 45, and right now in some markets we're in the low 60s. So we almost textbook case scenario, 50% drop, and now we're nearing the 40% up maybe 50% recovery from where we are. But some of us, which are fundamentally trained, are seeing that the efficiency in production will continue to put a little bit of a cap on prices where we don't think $100 is back, and the new normal is at a much reduced level. So I think we'll be available to answer questions a little bit later, but that's really the message I have to give you today. Thank you very much.